When we want to talk about different costs for different purposes, we can start asking the question, if the enterprise is making profits, is it doing well? What is the first sign of an enterprise failing? How do we know an enterprise is going through good times or they're going through bad times? What is the common companions during these times? When the enterprise stop making profits, can it survive? The key to this question has constantly remained the same, is the cash flows. If you take General Motors as a case example, the old General Motors began its operations in 1908, more than a century ago. But in 2009, General Motors became New General Motors under the Chapter 11 enterprise reorganization due to its going into bankruptcy. The question here is, why did General Motors stop making profits? For an enterprise to have a decreasing profits, there are 5 signs that we have to look at, or 5 aspects that we have to look at. First is the products. In General Motors, they were making cars that people didn't want and they could not sell these products. Second is innovation. They were too slow to innovate, partly because of its size. Third is adaptability to the environment. General Motors was too bureaucratic and was unable to change to market needs. Fourth is the manageability. They had a large dealer network. It was too large and became unmanageable. Fifth is the cash flows. They had to sell off its formerly profitable financing business to survive. In General Motors situation, on 8th of June 2019, there was a bailout. The bailout was done to transform from old General Motors into new General Motors because old General Motors wanted to go into bankruptcy with its liabilities. The financial restructure that came into effect before the new General Motors came in, they shed several brands and stopped making some brand vehicles like Saturn, Pontiac, and Hummer. And they also sold Saab. In times of insolvency of especially large enterprises, the government has a role to play. And there are 2 aspects here. One are the social costs, the second are the social benefits. The social cost to the government in the intervention was US Treasury invested $49.5 billion in the new General Motors shares. In 2013, it recovered $39 billion by selling those shares by incurring a loss of $10.3 billion. US Treasury also invested $17.2 billion into the General Motors former financing company, GMSC. And it recovered $19.6 billion when it sold its shares in 2014. making a gain of 2.4 billion. So there's a net financial loss, and that financial loss is a social cost. It's a social cost because there's a social benefit. The General Motors bailed out saved 1.2 million jobs. And because the new General Motors was floated, it preserved tax revenue of 34.9 billion. So why did all General Motors underwent bankruptcy? The answer to that is flexibility versus rigidity. When sales were decreasing, costs were not. To survive when sales were decreasing, some of the bigger costs must also decrease. Not selling many cars can lead to close of manufacturing plant, staff layoffs, and reducing material purchases. In the case of General Motors, they had high fixed costs in related to the union contract, and closing a plant and staff layoff are expensive, and there are additional costs to be paid to employees on pensions, and legacy healthcare costs were also fixed costs that General Motors had to incur. So rather than paying those costs, General Motors decided that all General Motors will go into bankruptcy and then float a new General Motors. So there are two types of costs in an enterprise: direct costs and indirect costs. When we talk about costs, these costs are assigned to a cost object. Cost object is where cost measurement is decided. It could be a product, it could be a service, it could be customer, department, or center. There are different cost classifications. And there are costs that are directly related to the cost object, and there are costs that are indirectly related to the cost object. Those that are directly related to the cost object can be directly assigned to the cost object. Those are indirectly related. They are assigned based on certain agreed rules. So there are direct costs and indirect costs. But these direct and indirect costs could be either fixed costs or variable costs. The costs could vary with the volume of production, or costs would not vary with the volume of production. They're fixed. If you take an example of a production department, production manager salaries is a direct cost, but it's a fixed cost. Materials, the metered electricity on production is a variable cost, and it's a direct cost. The delivery cost of production of goods It's an indirect cost, but it varies with production. Salaries in the finance department that serve the production department, it's a fixed cost, but it's an indirect cost. So one classification is to look at costs as direct and indirect. Another classification of costs is to look at them as variable and fixed. But the challenge here is how accurately we can assign indirect costs to cost objects. We know that the fixed costs and the variable costs, they both can be direct costs or indirect costs. So the factors that we must consider in assigning indirect cost to cost object is how material is the cost item, the available information, and whether we can gather this information, whether sufficient technology or capabilities are there to gather such information. And third is the design of operation. Is this cost assignment, cost allocation is exclusive to cost objects? The general rule is broader the definition of cost object, higher the proportion of total cost that the cost object can accept. And it brings more confidence to the manager about the accuracy of the cost allocation. So we talk about indirect costs and fixed costs. Indirect costs are operational costs. Fixed costs are strategic costs. That means it's long-term costs. And indirect costs are short-term costs. So when we look at the planning, control, and decision-making aspects, in planning, indirect costs take center stage in budgeting, and fixed costs take center stage in strategic plans. When it comes to controls, indirect costs take operational focus and fixed costs take strategic focus. And the decisions about indirect costs are made by the operational teams, like the management, junior and middle management, and about fixed costs is the senior management who makes such decisions. There are direct and indirect costs that vary with the variation in the cost output. For example, building a house. So there are resources as inputs, which are building materials, and the cost object as output is the house cost. Now, some of these building materials may be indirect costs, and we have to assign these indirect costs into the cost object, the house. To assign, to allocate using a rule, we must then find how this building material cost is driven to build the house. How is the housing cost determined using building materials? We have to look at what causes its change in input with the change in output. So that's the cost driver, and that cost driver could be the material cost of the building material. Fixed costs do not have cost drivers because they're fixed. They're not. Only the indirect costs and direct costs have cost drivers. So there's a causal relationship between input costs and the output costs, and they can be caused by more than one cost driver. It's important to identify the key cost driver in this causal relationship when there are several cost drivers. The costing system that identify the cost drivers by activities conducted is called the activity-based costing system. Let's take an example. This problem focuses on the cost of operations. Here, the enterprise uses trucks to transport bottles from the warehouse to different retail outlets. There's variable direct costs and there's fixed direct costs. And we are required to calculate the total cost for two scenarios and the cost per kilometers for fuel and insurance if the truck is driven. And if you look at the 20,000 kilometers, the total cost is the variable cost, that's the fuel cost plus the insurance cost, and that equals 9,000. Cost per kilometer is 9,000 divided by 20,000 is 45 cents. Cost per insurance cost, if you want to calculate, it's 9,000 divided by 6,000. In the second scenario, when the truck is driven for 30,000 kilometers, there's fixed cost, doesn't change, 6,000, and our variable cost here is 30,000 kilometers at 15 cents, and the total cost becomes 10,500. Cost per kilometer equals 35 cents. And if you want to calculate per insurance, the total cost is 10,500 divided by 6,000. What we can see, cost per kilometer is decreasing with a greater mileage coverage done by the truck. There are total costs and there are unit costs. In the example of an enterprise that transport bottles from the warehouse to different retail outlets, where the variable costs are the fuel costs and the fixed costs are insurance costs, and when we calculate the cost per kilometer for fuel, it is for 20,000 kilometers. The cost of fuel 20,000 into 15 cents plus the fixed cost 6,000 insurance, 9,000 total, and the cost per kilometer is 45 cents. And in the second scenario of 30,000 kilometers is 30,000 into 15 cents plus 6,000. The total cost is 10,500. Cost per kilometer is 35 cents. When we look at the total cost and the number of units, what we can see is the fixed cost does not change with the volume of production or the number of kilometers that's been covered in the distribution by the truck. The insurance cost does not change, but the petrol cost keeps changing. It keeps increasing with more distance that's been covered by the truck. So there are two aspects here. One is we can look at the total cost. That's the fixed cost plus variable cost. You also can look at per unit cost, that if we are transferring or transporting bottles, products as bottles, and then how much does it cost per kilometer? So the question here is, what should the managers focus on? Should they focus on the total cost or the unit cost? The answer to this is managers should focus on the total cost, because if they focus on the unit cost only, then they will disregard or they will not pay too much attention to fixed costs, assuming fixed costs as given, and they may not look at ways of decreasing fixed costs, which should be done because it has to decrease over the longer period. When we classify costs, another classification of costs are inventoriable costs and period costs. Inventoriable costs are costs that are capitalized at the time costs are assumed. For example, when inventory is purchased, that cost is capitalized and that becomes an inventoriable cost. Then there are also period costs, like for example, buying petrol for transportation. That's expense during the reporting period, that becomes a period cost. When it comes to type of inventory the inventory can have three categories of costs: direct material, work in process, and finished goods. These direct materials are converted into work in process, and that work in process become finished goods. Direct materials would have direct material costs, and then that direct material is then with manufacturing labor and other manufacturing costs, which are not direct but are indirect. They are being converted into towards outputs, and they are embedded in work in process and finished goods. Inventoriable costs are all costs of a product considered as an asset. So in the manufacturing sector, all manufacturing costs are inventoriable costs. In the services sector, all costs of purchasing goods are therefore resale, so often they are considered as period costs. So when we look at the manufacturing cycle, manufacturing costs, the inventoriable costs. When they become work in process, they are still inventoriable costs. When they become finished good, they're still inventoriable costs because they're shown on the balance sheet. And then when they are ready for sale and being sold out, that becomes cost of sales, and then it becomes period costs. Indirect costs, for example, rent, electricity, depreciation, are not always period costs. Because some cost objects output exists for more than a year. For example, in manufacturing, they become assets. So then that asset becomes an inventoriable cost. Some cost object output exists for less than a year, and those cost objects are incurred, and they, like for example, research or distribution, and they become period. Let's look at how we compute total manufacturing costs. So there's beginning inventory, purchases, ending inventory. Then there's direct manufacturing labor costs, and there's manufacturing overhead costs. So we need to calculate the total manufacturing costs incurred. Direct material used here is 12,000 plus 85,000, and we have to take away the inventory that was not converted into finished good, which is 7,000. That equals 90,000. Total manufacturing costs are the direct materials used, 90,000, plus direct labor costs incurred, 30,000, plus the manufacturing overhead costs incurred, 40,000, and that becomes 160,000. Prime costs are direct manufacturing costs. So they are the direct material costs. In the example we took, it was 90,000, and direct labor costs, which is 30,000, and the prime cost is 120,000. The conversion costs are the costs incurred in converting the direct materials into a product. So there's direct manufacturing labor cost of 30,000, and then there's manufacturing overhead of 40,000. So the conversion cost is 70,000. This cost is required to convert the material into finished products. Two methods of costing inventories in the manufacturing industry are variable costing and absorption costing. In the variable costing, all variable manufacturing costs are included regardless whether they are direct or indirect for cost calculation, whereas in the absorption costing, all variable costs, direct and indirect, are included. Additionally, all fixed manufacturing costs are also included in the costing calculation. It's important to understand the implications of fixed versus variable costs to enterprises. If you look at the staffing costs, the full-time staff can be considered as fixed costs, and the casual staff can be considered as variable costs. And for these two categories of staff, There are additional costs that are involved in addition to their salaries. These are called on-costs. There are some common on-costs to both categories, which is the superannuation guarantee, workers' compensation insurance the enterprise must take, and the payroll tax that the enterprise must pay. But it's in some states and it can vary, the rate can vary. And then additionally, there's annual leave loading and long service leave loading that applies to the full-time staff but does not apply to the casual staff. So there are two aspects here. One is the casual staff cost can vary with the volume of production, can align with the volume of production, and also the casual staff, which is the variable cost, could be cheaper, less costly than the full-time staff in that alignment.